Welcome to the deep dive. We've got an interesting one for you today, all about managing risk and maybe even, getting rich.
Oh, yeah. Who doesn't like the sound of that?
Right. So this is all based on a book called the Zurich Axioms by Max Gunther. And you specifically reached out wanting to really get a handle on like smart ways to handle money.
Fast tracking that financial knowledge, right?
Exactly.
Yeah.
So we dove into this book and pulled out, I think, what are the most important and impactful ideas just for you.
The cool thing about the Zurich Axioms is that it kind of flips the script on a lot of the traditional financial advice that's out there. It really makes you think differently about risk.
Yeah, the whole idea that life is, at its core, especially when it comes to money, a series of bets. Like if you want to see some real growth, you got to be willing to take some chances.
Calculated risks, of course. And that's where the whole Swiss thing comes in, right? Gunther uses them as an example, saying that the Swiss, they're not successful bankers because they avoid risk. It's actually because they understand it, like really understand it and know how to manage it.
That's interesting. So it's not about playing it safe all the time. It's about knowing which risks are worth taking.
That's the heart of it, yeah. And that's what these axioms, these kind of rules, are all about.
One of the first things that kind of blew my mind was how the book talks about speculation and investment. Like, it almost says they're the same thing.
It does, doesn't it? Gunther argues that anytime you invest, there's always some level of speculation involved. He even uses examples like, remember IBM, General Motors?
Like blue chip stocks.
Right.
The ones everyone thinks are super safe.
Exactly. But even those, he says, had a lot of risk, especially if you bought them when everyone thought they were at their best.
So even those so-called safe bets aren't really guaranteed.
Right. And the book even quotes this guy, Gerald Loeb. He said, all investment is speculation. The only difference is that some people admit it and some don't.
Huh. Makes you think, right? Okay, so let's jump into the first big axiom. It's about risk, and it's pretty bold. Worry is not a sickness, it is a sign of health. If you are not worried, you are not risking enough.
Wow, that's getting right to the point.
Yeah, it's basically saying that if you're not feeling at least a little bit anxious about your finances, maybe you're not pushing hard enough for growth.
Like a little bit of worry is a good thing.
That's what it's suggesting, yeah. And then it goes on to this first minor axiom. Always play for meaningful stakes. Now, this goes against what a lot of people say, right? Only bet what you can afford to lose.
I've heard that a million times.
But this book says if you're only risking a tiny amount, like an amount that losing wouldn't even bother you, then the potential reward is probably going to be tiny too.
So, like, those small, safe bets, they're not going to make you rich.
Right. The book uses the example of winning a small lottery prize versus making a bigger, scarier bet, like what J. Paul Getty did with that early oil investment.
He basically bet a huge chunk of his savings.
Yeah, and he knew if he lost it, it would be tough, but he'd figure it out. But by taking that risk, he opened himself up to the possibility of, like, life-changing wealth.
The kind of reward that a small, I can afford to lose this bet, just wouldn't give you.
Exactly. Okay, the next minor axiom is maybe even more controversial. Resist the allure of diversification. I mean, haven't we always been told to spread our investments around?
Don't put all your eggs in one basket, right? That's what they always say.
But the Zurich Axioms actually argues against that. It says if you've got your fingers in too many pies, so to speak, it gets really hard to manage.
You can't possibly keep track of everything, know all the ins and outs of every single investment.
Right. It's like being a jack of all trades, but a master of none.
And the book's advice: focus. Pick a few things you really understand that you can watch closely and go all in on those. It even says, put all your eggs in one basket and then watch the basket.
Wow. Okay, that's pretty bold. Let's move on to the second major axiom. This one's about greed. Always take your profit too soon. Now, this one's tough, right? Because our instinct is to hold on, to try to squeeze out every last bit of profit.
It's hard to walk away when things are going well.
Exactly. But this axiom says greed, wanting more than you initially planned for, can actually sabotage your long-term wealth.
The book talks about this casino manager, Sherlock Feldman, who noticed that the people who walked away with the most money weren't the high rollers. They were the ones who aimed for smaller, more consistent wins.
So it's like better to have a bunch of singles than to strike out trying to hit a home run every time.
Yeah. And another point the book makes is that, those stories you hear about people winning big and then losing it all? That's actually more common than, the ones who win big and stay winning.
So the key is to know when to quit while you're ahead, even if you think it might go higher.
Exactly. The book even has a minor axiom for that. Decide where the finish line is before you start the race.
Okay, so have a clear goal in mind before you even start. Like say, I'm going to sell when the stock goes up 50%.
Right. Having that target helps you resist that temptation to keep pushing for more and more.
And it probably helps with the whole regret thing too. Seeing something keep going up after you sold it.
The book says that happens to everyone, but in the long run, taking your profits early, consistently, leads to better results.
All right, third major axiom. This one's a bit dramatic. On hope, when the ship starts to sink, don't pray, jump.
Whoa.
It's a powerful image, isn't it?
It is. And it's basically saying, listen, you're going to have losses. It's part of the game.
Some of your ventures, your investments,
Yeah.
they're just not going to work out.
Right. And the key is knowing when to get out, to cut your losses before they get too big. The book even quotes this guy, Martin Schwartz, who won a big trading competition. He said he learned how to lose. Which honestly sounds counterintuitive, but I get it. Knowing when to let go is huge.
And that's what this minor axiom is all about. Accept small losses cheerfully, as a fact of life. Expect to experience several while awaiting a large gain.
Cheerfully, huh? That's easier said than done sometimes.
I know, right? But the point is, small losses are normal. They're almost like the price you pay for the chance to win big later on.
It's like those small losses, they protect you from those really big, devastating ones.
Okay, the fourth major axiom takes aim at something we all probably do too much of, trying to predict the future. It says, on forecast, human behavior cannot be predicted. Distrust anyone who claims to know the future, however dimly.
Ooh, yeah, I've definitely fallen into that trap before.
Right. We all want to know what's going to happen, especially with our money. But this book is saying all those experts, those forecasts, they're often wrong.
And it gives some examples, like all those predictions about inflation back in the 70s and 80s, many of which just totally missed the mark.
It even talks about this guy, Joseph Granville, who was like this big market guru. He told everyone to sell everything before a supposed crash.
What happened?
Well, the market did dip, but not nearly as bad as he predicted. And a lot of people lost money because they listened to him.
So the lesson is, don't rely too much on predictions.
Right. It's better to focus on what's happening right now in the market and have a plan for how to react to it.
Instead of trying to guess what might happen later.
Okay, the fifth major axiom. This one's kind of philosophical. Chaos is not dangerous until it begins to look orderly.
What does that mean?
Well, it's basically saying that the market, it's inherently chaotic, it's unpredictable. But our brains, we like to find patterns. We like to feel like we're in control.
Oh, I see. So when we think we've figured out a pattern, we can get overconfident.
Exactly, and that's when we make bad decisions. The book uses this example of an art fund, the Sovereign American Art Fund.
What happened there?
Well, the idea was that American art would always go up in value, right? Seems logical. But then tastes changed. The market shifted, and the fund lost a ton of money.
So even a seemingly safe bet can go wrong if you're relying on a perceived pattern that might not hold true.
Right. And the book also talks about unit trusts, mutual funds, and how even those, even with professional managers, are still subject to the chaos of the market.
No guarantees.
And this leads to a couple of minor axioms. The first one is, beware the historian's trap.
Okay, what's that?
It's the idea that history repeats itself and that we can use it to predict the future of the market. But, things change.
Right. The past doesn't always tell you what's going to happen next.
Exactly. And then there's the gambler's fallacy.
Yeah.
This is like when you flip a coin and get heads 5 times in a row, you start to think tails is due.
Yeah, but each flip is still 50-50.
Right. And this fallacy can get you into trouble in investing, like thinking a stock has to go up because it's been going down for a while. The book talks about these two gamblers, Caroline Otero and Charles Wells, who won big at roulette, but eventually lost it all because they kept thinking their luck would hold.
So basically, don't get tricked by patterns that aren't really there.
Exactly. All right, the sixth major axiom is about mobility. Avoid putting down roots. They impede motion.
So don't get too attached to anything.
Right. And this isn't just about physical location. It's more about a state of mind.
Being willing to change, to adapt.
Yeah. And this is where we get to 2 more minor axioms. The first one is, do not become trapped in a souring venture because of sentiments like loyalty and nostalgia.
So sticking with an investment just because you've had it for a long time or because of some emotional connection.
Exactly. The book gives this example of these people who wouldn't sell their house, even though it was losing value because they were so attached to the neighborhood.
That's kind of sad. But I guess it makes sense. Sentiments can cloud your judgment.
Right. And the next minor axiom is, never hesitate to abandon a venture if something more attractive comes into view.
So always be on the lookout for better opportunities.
Yeah. Don't get stuck in something that's not working just because you've already put time or money into it. The book talks about this computer company, Boy Computer, that kept investing in a failing project when they could have been putting that money into something much better.
So be flexible, be willing to move on.
All right, the seventh major axiom is about intuition. It says, a hunch can be trusted if it can be explained.
Interesting. So it's not saying intuition is bad.
No, not at all.
Yeah.
In fact, it says intuition can be really valuable, but you have to be able to understand why you have that feeling.
Like, what's the logic behind it?
Exactly. The book even says, never confuse a hunch with a hope.
Oh, that's good. Because we tend to believe the hunches that we want to be true.
Right. So be extra careful with those. If you have a hunch about something, really try to figure out what's driving it. If it's just wishful thinking, be wary. But if you can find some solid reasoning behind it, it might be worth listening to.
Okay, that makes sense.
Now, the eighth major axiom is pretty straightforward and kind of funny. On religion and the occult, if prayers can help, why are there poor bookies?
Huh. That's a good point.
The book is basically saying, don't rely on supernatural stuff when it comes to your finances.
Leave the tarot cards and lucky charms out of it.
Exactly. It talks about this guy, Jesse Livermore, who was a super successful trader. He sometimes talked about having this mystical intuition about the market,
Ugh.
but he also lost everything multiple times. The book uses his story as a warning, don't think you've got some special connection to, I don't know, the universe or whatever that's going to make you rich.
Stick to logic and analysis.
Right. The ninth major axiom. This one's about our mindset. On optimism and pessimism. Optimism means expecting the best, but confidence means knowing how to handle the worst. Never make a move if you are merely optimistic.
That's a great distinction.
Right. It's saying optimism is good, but it's not enough. True confidence comes from understanding what could go wrong and having a plan for dealing with it.
So don't just hope for the best, prepare for the worst.
Exactly. The book compares it to gambling. An amateur gambler, they might be super optimistic, but they don't really understand the odds. A professional gambler, they're confident because they know the risks and they have a strategy.
They know when to fold, when to walk away.
And we give this example of this couple, Sam and Judy, who were trying to sell some land. They were so optimistic about getting a high price that they didn't even think about what they'd do if they didn't get it. And they end up missing out on some good opportunities because of that.
So don't let optimism blind you to the potential downsides.
Okay, we're getting close to the end. The 10th major axiom is all about thinking for yourself. On consensus, disregard the majority opinion as it is probably wrong.
Oh, that's contrarian.
It is. But the book says just because a lot of people believe something, especially in finance, doesn't mean it's true. It even talks about this philosopher, René Descartes, and his idea of questioning everything.
Don't just follow the crowd.
And this leads to the minor axiom. Never follow speculative fads. Often, the best time to buy something is when nobody else wants it.
That makes sense. Like when everyone's piling into something, the price is probably already inflated.
Right. It uses the example of those experiments where people would conform to the group even when they knew the group was wrong.
The Asch conformity experiments, right? Fascinating stuff.
Yeah. And it shows how powerful that herd mentality can be, especially when it comes to investing. Remember all those people who bought gold when the price was skyrocketing?
Or tech stocks during the dot-com bubble.
Exactly. They followed the fad, and a lot of them lost a lot of money.
So the key takeaway is to be a contrarian. Go against the crowd. But, and this is important, the book says, don't be contrarian just for the sake of being different. You still have to do your research, understand the investment, and make a reasoned decision.
Okay, almost there. The 11th major axiom is about stubbornness. If the first gamble didn't work, forget it. So this is about knowing when to cut your losses. But even more than that, it's about not trying to chase those losses by throwing good money after bad.
Like doubling down on a losing bet.
Exactly. And the minor axiom for this is super clear. Never try to save a bad investment by averaging down.
Averaging down, what's that?
It's when you buy more of an investment that's losing value, thinking that'll bring your average cost down. But the problem is the investment itself is still bad.
Oh, I see. It's like trying to fix a leaky boat by buying more buckets.
Perfect analogy.
Yeah.
The book uses the Boy Computer example again, showing how they kept pouring money into a failing project instead of moving on.
So the lesson is don't get emotionally attached to a losing investment.
And don't try to force it to work.
If it's not working, walk away.
Okay, last one. The 12th major axiom is maybe the most surprising, especially for people who love making detailed plans. quote, on planning long-range plans engendered the dangerous belief that the future is under control. It is important never to take your own or other people's long-range plans seriously.
Wow, that's going against a lot of what we're taught.
I know, right? Like, financial planning is supposed to be all about the long term. But this book is saying those long-term plans, they can give us a false sense of security.
Because we can't predict the future.
Exactly. It tells a couple of stories, one about this couple who had a super strict financial plan that ended up backfiring, and another about someone who invested in Ford stock for the long haul, thinking it was a sure thing.
But things change. Companies change.
And the minor axiom for this is shun long-term investments. It's saying betting on the distant future is just too risky. The only real long-term plan you need, the book says, is the intention to get rich.
And to stay flexible, right?
Exactly. Be ready to adapt as things change.
Yeah.
Okay, so that was a lot to think about. For you, our listener, if you're trying to wrap your head around all this, here's some of the key takeaways.
Yeah.
Embrace calculated risk. Don't be afraid to take a chance if it's a smart one. Take your profits early. Don't be greedy. Cut your losses quickly. Don't try to hang on to a sinking ship. Don't trust forecasts. Remember, the market is chaotic. Stay mobile. Be willing to move on to better opportunities. Question your intuition. Make sure it's not just wishful thinking. Don't mix money and superstition. There's no magic formula. Be confident, not just optimistic. Have a plan for when things go wrong. Think for yourself. Don't follow the crowd. Don't be stubborn. Walk away from losing investments. And be wary of rigid long-term plans. Stay flexible.
Those are some powerful principles.
They are. And the Zurich Axioms, it's really all about challenging how we think about money and risk.
It's a different way of looking at things.
So here's a final thought for you to ponder. Out of all these axioms, which one really pushes back against what you currently believe about money? And why do you think that is? How might changing your perspective, even just a little bit, based on these ideas, change how you approach your financial goals? This deep dive, it's just the start of your journey. Keep exploring, keep questioning, and see where it leads you. Thanks for listening.